Welcome to Young and Wealthy, the controversial road to financial freedom. Today we'll explore how starting early, cutting cash drag, leveraging ISA advantages, and boosting your income can dramatically accelerate your wealth journey. To set expectations, we'll move from the big picture to tactical steps and finally finish with key takeaways and quizzes. Let's begin. Here's the roadmap for this session. First, we'll outline the big idea. Next, we'll dive into why cash drag is costly and how to correct it. Then, we'll compare LISA and Help to Buy. After that, we'll look at boosting your income. Finally, we'll lock it in with an action plan, diagrams, and quizzes. Let's transition to the big idea. The core thesis is simple. Starting early and maintaining an aggressive, diversified approach can yield compelling long-term outcomes. Rather than trying to time the market, focus on time in the market, using low-cost global index trackers. With that foundation, let's move from concept to the cash allocation decisions that either accelerate or stall your progress. Holding a substantial amount of cash in a low-interest cash ISA leads to opportunity cost. After prioritizing a robust emergency fund, typically 3 to 6 months of expenses, about £5,000 to £8,000, move the remaining funds into a diversified global index fund within a stocks and shares ISA. This reduces cash drag and exposes your capital to growth. Set up automatic monthly contributions to enforce discipline. Now that we understand the cash decision flow, let's broaden the strategy lens with the Wealth Pillars mind map. This mind map organizes the journey into 5 branches. Cash management covers emergency funds, using high-yield accounts, and minimizing cash drag. Investing focuses on diversified global index funds, keeping fees low, and prioritizing time in the market. Property goals emphasize maximizing the LISA bonus, understanding Help to Buy limits, and respecting withdrawal rules. Income Power highlights upskilling, side businesses, and negotiating salary. Finally, Risk reminds you of market volatility, your time horizon, and personal risk tolerance. With the big structure in place, let's compare LISA with Help to Buy to capture free money effectively. On the left, the Lifetime ISA allows up to £4,000 per year, with a 25% government bonus, capped at £1,000 per year. It has a nationwide property price cap of £450,000, must be opened between ages 18 and 39, and imposes a 25% penalty on non-qualifying withdrawals. You also need to wait 12 months from the first contribution before using it for property. On the right, the Help to Buy ISA is a legacy product closed to new accounts in 2019. It allows contributions up to £200 per month, with a maximum bonus of £3,000. Its property cap is £250,000 outside London and £450,000 in London. The bonus mechanics differ and are applied at completion. If your purchase is imminent, some may stick with Help to Buy. Otherwise, if the timeline is longer, the Lifetime ISA often provides more value. With a comparison in mind, let's cement facts with a quick reference table. This table summarizes key UK-specific points. The Stocks and Shares ISA has a £20,000 annual allowance. The Lifetime ISA allows up to £4,000 per year and adds a 25% bonus up to £1,000. The LISA property cap is £450,000 nationwide, with a 12-month waiting rule from the first contribution. Non-qualifying LISA withdrawals incur a 25% penalty. Help to Buy ISAs are closed to new accounts, though existing holders may continue under specific rules, and the maximum bonus is £3,000 paid at completion. An emergency fund of 3 to 6 months, approximately £5,000 to £8,000, should be held in a high-yield easy access account. Finally, excess low-rate cash creates cash drag, so shift surplus to diversified equities. Now let's convert this into a concrete action plan. Follow these 7 steps. First, calculate 3 to 6 months of expenses and set your emergency fund target. Second, move surplus cash above approximately £5,000 to £8,000 into a Stocks and Shares ISA, focusing on a diversified global index fund. Third, if you are a first-time buyer and the timeline is not imminent, open a Lifetime ISA and contribute up to £4,000 per year to capture the 25% bonus. Fourth, automate monthly investing on payday to reduce emotional decision-making. Fifth, invest in upskilling or a side business to increase your earning power. Sixth, keep remaining cash in high-yield accounts rather than legacy low-rate ISAs. Seventh, revisit your allocation annually, prioritizing diversification and low fees. Having set the plan, let's visualize allocation with a quick pie chart. Here is an illustrative allocation after funding your emergency buffer. roughly 85% in a global equity index, 10% in global bonds, and 5% in high-yield cash. This is intentionally aggressive and assumes a long time horizon and higher risk tolerance. Use low-cost index trackers to minimize fees and rebalance either annually or when allocations drift beyond your thresholds. Next, let's look at why time in the market beats timing with a timeline diagram. This timeline shows a journey where you start investing small, build habits and the emergency fund in years 1 to 2. Then increase contributions in years 3 to 5. Between years 6 and 10, you ride through market cycles rather than attempting to time them. Beyond 10 years, compounding becomes a primary driver of growth. Automation helps you remain invested and capture more of the market's positive days. Now, let's test your understanding with a quick quiz. Quiz time. Which account offers a 25% government bonus up to £1,000 per year on contributions up to £4,000? Option A, Lifetime ISA. Option B, Help to Buy ISA. Option C, Cash ISA. Option D, Personal Pension. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, the Lifetime ISA. It offers a 25% bonus on contributions up to £4,000 per year, capped at £1,000 bonus annually. Remember the 12-month waiting period before use for a property and the 25% penalty on non-qualifying withdrawals. Now let's continue with another quick question. Second quiz. What is the recommended size of an emergency fund before investing the remaining cash more aggressively? Option A, 1 to 2 weeks. Option B, 3 to 6 months, approximately £5,000 to £8,000. Option C, exactly £20,000. Option D, no emergency fund needed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, 3 to 6 months of expenses, typically around £5,000 to £8,000 in this scenario. This buffer helps avoid selling investments at a bad time and stabilizes your plan. Next, let's talk income power plays to accelerate your journey. Beyond saving, increasing your income can accelerate wealth far more quickly. Consider targeted upskilling for roles with higher compensation or pursue promotions. Explore side businesses that offer asymmetric upside relative to your time investment. Negotiate your salary to lock in higher compounding over future years. Then, direct the additional income into your stocks and shares ISA or Lifetime ISA to magnify long-term growth. Now, let's tighten your cash management to avoid unnecessary drag. To minimize cash drag, keep your emergency fund in the best-rate, easy-access accounts you can find. Avoid leaving money in older, low-rate ISAs. Use standing orders to replenish your buffer while automatically investing surplus funds. Review savings rates each quarter because providers frequently adjust offers. With tactics in place, let's consolidate the most important points. Here are the essential points. Time in the market is more powerful than timing. Build a 3 to 6 month emergency fund, and then invest the rest aggressively in diversified, low-cost trackers. Use a Lifetime ISA for first-time home purchases if your timeline can accommodate the 12-month rule and other conditions. Automate contributions and keep costs low. Finally, boost your income to accelerate your results. Before we close, let's summarize and add a clear disclaimer. In summary, reduce cash drag by securing your emergency fund and investing the remainder. Leverage the Lifetime ISA if eligible to capture the 25% bonus. Automate contributions. Maintain diversification through global index funds, and keep costs low. Increase your income through upskilling, side ventures, and negotiation. Review savings rates quarterly and your allocation annually. Now, as promised, here is a clear disclaimer tailored to this content. This video is for education only and does not constitute financial advice. All investments involve risk and can go down as well as up. UK tax rules, ISA and LISA regulations, allowances, and eligibility criteria can change, and their applicability depends on your circumstances. Always do your own research and consider seeking advice from a regulated financial advisor before taking action. With that noted, let's conclude. Thank you for watching. If this video helped you reduce cash drag and capture the Lifetime ISA bonus, please like the video, share it with a friend who is on their wealth journey, and subscribe for more content. Leave your strategies and questions in the comments so we can discuss and learn together. See you in the next episode.